And for more on the Chinese insurance shopping spree, we're joined by Amir Korangy. He's the publisher of The Real Deal and a veteran New York real estate expert. Amir, good to have you back on the show.
Thank you for having me back.
So, Amir, the Waldorf Astoria, Lloyd's of London, the UK's top law office, now all owned by Chinese insurance companies.
And in cash.
And in cash. So it's certainly a seller's market. But I want to talk about the target properties that these Chinese insurance companies are going for. What's the profile?
Well, they're looking for stuff, not necessarily the best deals, but the best assets. And if you're an entity with unlimited amount of cash, which is the Chinese insurance companies are, that's who you are. You have unlimited amount of cash.
Well, it's not unlimited.
Well,
it's $1.6 trillion. That's a lot of cash.
Right. That's enough for you to do a lot of damage in terms of purchasing power. But so when you have that kind of cash, you could come and buy the Waldorf Astoria at market price with a yield of 1.5%, 2%, which is below market, as Karina said. But one thing that historical data has always shown us is that New York City real estate continues to go up. It has its market corrections, but when you have that kind of cash, you buy great assets and you watch it go up.
Well, they are really vying for these trophy properties in New York, in London. What do you think are other potential targets?
Well, it's obviously they're the most sustainable. The trophy properties are the ones that are going to keep their value the most, and that's great. That's a great investment. If you can afford to get into the trophy assets, that's the place you want to be in, and these people can afford to be in that. But now we're seeing a lot of, for them JVing and joining with other big developers here in the States and building new developments, like the Hudson Yards development, which is the largest development in U.S. history. And $700 million of that is from Chinese investors. And the same for the Atlantic Yards in Brooklyn. $500 million of that is from Chinese investors.
Well, these Chinese insurance companies have, as we said, $1.6 trillion to spend.
Yeah.
What does this mean for the market? What impact is this going to have? Obviously, this is going to push prices up.
It's going to be tremendous. Well, it's going to push prices up. The prices are already pretty high up, so I can't imagine them going up any further. But it will affect it a decent amount. But
well, last year, office prices in central London were up about 15%. In New York, they were up. In Manhattan, specifically, they were up over 11%. Is there more room to rise? At what point could we be hitting a bubble here?
Well, in 2007, we had $62 billion in asset sales in New York City alone. And this year we had $58 billion in asset sales. So we haven't really surpassed the record as far as New York City is concerned.
So you're not in any concern that this could form a bubble?
There's too much interest from around the globe in New York City. So when you have that much interest coming into New York, it's not just the New York consumers. You're talking about the entire global community that's investing in New York because it has one of the freest economy, not in New York, but in the States. But of course, New York is the capital of that when it comes to real estate assets. So when you have the freest economy, one of the freest rules of land, in the entire globe, it makes it a safe bet. New York City real estate has become the Swiss bank account of the global economy.
That's quite an endorsement. Well, a lot of money is being poured into London as well. No one can dispute that. In fact, Min Sheng is spending about $1.5 billion to build a new financial district in London, a third one after the City and Canary Wharf. Do you think that'll pay off?
I can't speak on London, but I can tell you the stuff that they're doing in New York with the Waldorf Astoria. You mentioned that today, and we broke the news today that Bang is actually planning to make the top floors of that into condominiums. So that's going to be a nice change, and it's going to be sort of a different dynamic for what they're normally doing.
Amir, let's talk about interest rates and the way they're factoring in here. This is creating an incentive because borrowing money is so cheap, and also investors aren't getting much yield from fixed income. So is that pushing more of these investors into properties?
Yeah, I could see that happening. But again, the insurance companies that we were talking about, they're not necessarily looking for yields. They're not looking for immediate returns. They're not borrowing money. They're buying these places in cash, which is tremendous. That's very unusual in this market. but especially for the prices that they're paying for them.
So what is the end goal?
The end goal is to have your money parked in a very nice place. Look at 70 Wall Street, okay? Sufon or Fang bought that in 2012, 2011. It's been sitting there empty. They bought it in cash. It's been sitting there empty. They have no plans of what to do with it next. And
Well, that doesn't sound like a good investment to me.
It doesn't sound like a good investment, but they wanted to get the money out, and they've put it out there. They're not necessarily looking for that immediate yield. Chinese are generally, long-term buyers.
Amir, the Japanese were considered long-term buyers. They went on a massive U.S. shopping spree in New York in the 1990s, buying the likes of the Rockefeller building. That didn't work out so well.
They had debt. The Chinese buyers don't have debt. They're buying these places in cash, and they're very smart in the way that they're JVing. So they're joint venturing with really top-end developers like Related, like Forest City Radnor, people who know what they're doing in this market. So that puts them in a different place than where the Japanese were.
Okay, thank you so much.
My pleasure.
Amir Korangy, publisher of The Real Deal.